Hi everyone, we're here at the PDAC 2022 mining conference in Toronto, Canada, one of the biggest conferences in the world, and I'm very, very happy to have Adrian Day of Adrian Day Asset Management with me. Let's talk about the markets. I mean, it's been just on an unprecedented volatility over the last few years, a lot of ups and downs, a lot of speculative investing, but one thing I want to talk about that is, big inflation. Inflationary pressures are roaring worldwide. What can we see from the world going forward in terms of inflation? Is it persistent, stagflation, deflation? I mean, what's going on here?
I think I'd like to step back, if I may, and just look at what is inflation. A lot of people think, and a lot of people includes the President of the United States, Russia invaded Ukraine, so oil prices are up, therefore we've got inflation.
Right.
But inflation is when you have aggregate prices going up, not just one price or two prices or three prices. You have prices in aggregate going up. You only ever get prices in aggregate going up when there has been excess money creation.
Okay.
As Milton Friedman said, inflation is always and everywhere a monetary phenomenon.
Interesting. Okay.
So we've had excess money creation both in the United States and around the world in varying degrees. Mm-hmm. Canada less than many other countries, but we've had excess money creation, and that money still exists, and that excess money is what's making prices go up. So I think it's going to last for a little while, frankly. Whether the rate of change is going to moderate, that's a different issue.
Yeah.
But as one of my friends, Lobo Tigre, put it very well, if you're climbing up a hill and the gradient gets a little less sharp, steep, you're still climbing.
Right, yeah.
Yeah.
So with inflation in Turkey, for countries like in Turkey, it's 60% or so, and you're looking at the US at around 5.5%, or is it
8.5%.
8.5%, right? Okay, yeah. 8.5%. What's the real inflation number then? I mean, obviously, those are two completely different economies and so forth. But what is the real inflation number then worldwide, really?
Well, worldwide inflation is not such a critical number, frankly, because as you say, different countries will have different inflation rates.
Right.
Venezuela had inflation of hundreds of thousands % for a while. Zimbabwe, was the most extreme case in the last 20 years. But that's because of the excess money created in each economy. So, if you look at the major economies of the world, Europe, Britain, Japan, China, North America, you're looking at the range of 6-7%. And that's using official numbers, of course.
Interesting. Wow. Okay, so we're in it for quite a bit longer here for inflation.
These are the highest inflation numbers in developed countries in 40 years.
Interesting. Yeah. Wow. Okay, so then let's talk about the precious metal space. You would think that precious metals would be trading at much higher prices given not only inflationary risk, but also just the amount of debt worldwide. I mean, you're looking at Japan at several trillion of debt. You're looking at the US at around 20. You're looking at China at around 10 worldwide. It's $226 trillion worldwide. What are we cooking up here?
Right. Well, we'll answer gold in a second, but you've hit on a really critical thing. I always hate to use those words, different this time. John Templeton, in my mind, the greatest investor of all time, said those are the four most dangerous words to use in investing. It's different this time. But what's different now than, say, in all the periods of inflation since 1970 is the amount of debt in the system.
Interesting.
And you hit on that. And that makes it much more difficult to increase interest rates, of course, because as you increase interest rates, some existing debt is at fixed rates, some existing debt is at floating rates. That debt goes up. But even the debt at fixed rates, a lot of that matures and needs to be rolled over.
Right, yeah.
So if you have more debt in a system, it makes it more difficult to increase interest rates because the rate that people are paying on debt is going up.
Right.
And if the economy is slowing at the same time, you're not generating enough revenue and income to service the debt.
Right.
Which means you lead to bankruptcies and failures and so on. And that, I think, is where we're heading right now. You know, many countries around the world, and the US certainly, is moving very close to a recession. And so you have inflation and you have recession, or a stagnant economy, and that's basically stagflation.
Right. Yeah.
And if you look at history, if you look since the 1960s, in a stagflation, energy tends to do very well, and precious metals tend to do very well. Mm-hmm. And after that, you know, very few asset classes tend to do well in a stagflationary period.
Interesting. So, you know, it's interesting you mentioned these points because I was talking to Jeffrey Christian earlier, and he was mentioning some interesting points back in the 70s where you referenced just now, and he was talking about hyperinflation back then compared to now and how it's different this time where, you know, there's still inflationary risk. There's going to be some sort of recession in the near term, but it won't be like it was in the 1970s. But we won't know, right? I mean, it's completely, just like you said, with the debt worldwide, we didn't have that back then. So
well, no two periods are ever the same.
Oh, yeah.
I mean, obviously.
Yeah.
So we look for analogies. What's the best analogy? So if you look at the last periods when the Federal Reserve started tightening, 2018, 2015, 2013, these were periods when they either started to raise rates or started to taper the balance sheet.
Right, yeah.
We had interest rates starting at zero, right? But we had debt levels that were lower than they are today, and we had inflation that was much lower.
Right.
So 2013, 15, and 18, you had official CPI increases in the US well under 2%. And the Federal Reserve was actually trying to increase inflation.
Yeah.
Which is perverse, but anyway, they were trying to increase inflation. Now, with inflation at 8.5%, you have a real, what do you want to call it? You have a real dragon to slay.
Right. Yeah.
Which you didn't have before. Now, if we go back to the 1970s, debt levels were certainly high back in the 1970s relative to the early 60s and 50s. Mm-hmm. You know, we had huge deficit spending in the US with Johnson's, well, with the war in Vietnam and with the war on poverty.
Right, yeah.
But what we're seeing today is the debt levels, the debt ratios are just far worse than they were in the 1970s.
And, you know, now I'm talking about the debt levels, I mean, just like you're saying, how to service that debt. We don't know how well it's being serviced. And the savings rate, I mean, that's not at optimal levels as well. So it will be a very trying period for the next several years. So
no, absolutely.
It's a whole bad recipe. Anyways, let's step back and let's talk about the mining sector. So I wanted to pose this question to you where, you know, you look at different sectors for value, right? And right now, the best performing sector right now, I would say, is the oil and gas sector. And there are some kind of a few similarities between both, you know, in terms of the producers anyways, right? You're seeing, you know, the oil and gas companies, they're getting very good valuations right now, and they're cutting their debt, they're streamlining their project pipeline, they're maximizing the cash, increasing dividend yields. Mining producers have done the same over the last few years. However, they're not trading at the same valuations.
Right.
What is going on here, and what does it take, you think, for investors to really look at the value that the mining producers are giving? So then the explorers eventually come, the developers.
Well, that's
et cetera.
Two different questions, of course.
Yeah.
You know, if you look at the oil and gas, you know, certainly the oil and gas prices have moved up much more sharply than have the gold and silver price.
Right. It's around 120 today.
Yeah, and gas, of course, has gone up even more, both in the US and particularly in Europe. So it's not surprising that the oil and gas the oil and gas producers have better valuations because of that huge increase in the prices. Mm-hmm. The difference in why, but those companies are not investing in projects.
Right, that's another point. Yeah.
Yeah, and are increasing their dividends for a different reason than we're seeing it in the gold market. In the oil and gas market, they're not doing that because, frankly, the developed world, the US, Europe, has made it plain that they want to get rid of the fossil fuel industry. Well, if you're the director of a big company and you're looking at a major project, like a deep sea underwater project, and you're looking at investing $10 billion, and you're not going to get a return on that for maybe 12 years, and President Biden just comes out and says, we want the world to be free of fossil fuels by 2030, are you going to invest some money? Of course you're not. And then you've got funds that are saying, we don't want to invest in oil and gas stocks. You've got banks that are saying, we don't want to lend to oil. So you say, forget about it. Why are we taking the risk? Let's just give the money back to shareholders. So that's a very clear dynamic in oil and gas that's not really apparent in the gold sector, at least in anywhere near the same degree. Very few people are saying we want to do away with gold mining.
Right, of course.
I think gold investors, we've had this. Gold investors always expect too much. If you look at gold and what it's done since 2015, and then particularly say since 2018, it's not been that bad.
No, not at all.
But we always expect more. I think what we're going to see with gold is, as it becomes apparent to the market that the Federal Reserve in particular, cannot increase interest rates sufficient to subdue inflation without causing a recession, then we're going to see gold move up. So when the Fed first talks about tightening, that's bad for the gold market, right? Everybody gets nervous, the Fed's going to tighten, interest rates are going to go up, blah, 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 that's bad for. But as the market realizes, as it becomes clear that they simply cannot carry through with those plans, then that becomes positive for gold. And I think we're at that turning point now, we're at that cusp now, where gold is beginning to say, we don't have trust and confidence in the Fed.
Well, it's been staying at a pretty good range. I mean, you're looking at around, lowest it went over the last month or so was like, what, 1820, 1830, I think, and now it's staying around 1850, 1870, so it's still pretty healthy. I mean, I think if you've seen some of the producers come out with, or developers who've come out with revised guidance, but their all-in sustaining cost is still pretty healthy, around $1,200-1,300 on average. And the capex for developers, they haven't revised it significantly. I mean, for the inflation, they're probably facing between 5 to 8% inflationary cost pressures, right? So it's not that bad.
No, for the industry, this is not bad at all. You've got very healthy margins. You've got a very nice price where you can make money and very healthy margins. I mean, there is a big question, of course, how much does inflation continue and cut into those margins? Because we saw that in the early 2000s, 2005 to 2008, although the price of gold, and I'm going right off the top of my mind now, went from 500 to 850 or something. But the margin in those years, the margin did not expand at all because the price of oil went up. Oil, energy is the number one input, as you know, operating input. And also the price of the commodity currencies went up. So the price of everything you buy in the local areas, Australia, Canada, Brazil, South Africa, where you're building the mines, all those prices went up, labor and everything else. So the margins didn't expand at all. But right now, I mean, the margins are holding up pretty nicely, I would say. And yet the valuations are ridiculous. You look at a company like Barrick, and it's trading very, very close to its all-time low in price to free cash flow. The industry is trading at lower multiples than the S&P, which is historic. That just doesn't happen. Gold companies are always trading at higher multiples. because you don't invest in gold
Yeah.
unless you're an optimist,
Yeah,
right?
yeah.
But right now, if you look at price to earnings, price to cash flow, price to book value, and dividend yield, the XAU, the index of the senior companies,
producers,
is trading at lower multiples than the S&P. First time ever.
Wow.
So not only is the outlook for gold and silver very, very strong in my view, not only is the industry is our investors very underinvested in the sector, in my view.
Yeah.
But the stocks are actually cheap.
Yeah. Well, then, that actually leads to my next question was in terms of what kind of metrics do you look at for developers or producers, even juniors, but more so, I guess, more towards what your points were mentioning, were price to cash flow, this and that. So what are some of the metrics you look at?
Well, I mean, I look at them all, and you're quite right that the metrics for the senior producers are different than the metrics from the junior producers, and especially the metrics for the explorers. I mean, right now, and I hate to say this at your booth, there's an old saying, when the filet's on sale, don't buy hamburger.
Yeah.
And that's nothing against hamburger, because I like hamburger.
Yeah.
But and the senior stocks are very, very cheap now. So we're actually buying more in the senior range than we have for a long time. Now, when I say more, I'm talking 40% of a portfolio in seniors. That still leaves 60 for juniors and exploration.
Yeah.
But with the seniors, I mean, I look at all the metrics, but I also look the valuation metrics, but I also look at management. I think management is critical, even with the big companies like Newman, Barrick, Agnico.
Right. Yeah.
Management is a critical component, and the smaller the company, then the more important it becomes.
Of course, yeah. But we've seen some interesting transactions this last year. There's always M&A in our sector, as always. But recently, you're seeing more M&A where the senior producers are just getting that division is just getting smaller and smaller and smaller. So what does that lead to for other? When you go down the scale here to the mid-tier producers, what happens with them now? You expect them to have some M&A to kind of move up to the upper tier, or what's going on here? Because there's just not much left.
No, you're right. Among the seniors, really interesting. And even now, when you look at the gold mining companies, let's say the top 10 or top 20 gold mining companies compared with the top 10 or 20 in any other industry, whether it's pharmaceuticals, food, whatever industry you care to look at, the gold mining companies are still very, very small companies.
Right. Yeah.
So now the consolidation, of course, is changing that. But I think eventually we're going to have to see the senior companies start looking at simply taking over the mid-tier producers.
Oh,
the difference, of course, is that Mark Bristow at Barrick, whom I respect a lot, keeps harping on about no premium mergers, and we had the Agnico Kirkland no premium merger. It wasn't a merger; it was a takeover, but nonetheless, we call it a non-premium merger to be polite, or for tax reasons. But the junior wants a premium. The junior is not going to merge with a senior at a no premium. They want a premium.
Yeah.
And so I think the mindset of some of the major companies has to change. Now we saw with Goldfields, they had a pretty attractive premium on Yamana, 40%. Of course, that premium evaporated as soon as the
Goldfield price went down. Yeah.
As soon as the deal was announced. If you look at the metrics, what were they paying? I'm not talking now whether it was a good deal, bad deal, synergies, or anything else. If you just look at what was Goldfield's pro forma valuation for Yamana on a price to cash flow, price to book, and everything else, it was right in line with Kirkland and Agnico and some of these other no premium mergers, right in line.
Right.
So they had to pay a premium because Yamana was so cheap.
Right.
But I think a junior producer, demands a premium,
right.
and the shareholders demand a premium.
Yeah.
But I think you're going to get that. I mean, you have to get that eventually.
Yeah. Well, it's been just interesting. I mean, given prices are still very strong. You're still seeing a lot of activity out there, and it's going to be a lot more because it's going to be, with inflationary costs, we're going to be looking at the king of these kind of deposits that are churning out profits, right? And that's all that matters now.
Especially in good jurisdictions, because people are more, and you've seen that in Canada, obviously.
Right, of course, yeah.
Kinross buying Great Bear before there's even a pre-feasibility or a resource is astonishing. Yeah. But it's a sign of the times. There are only so many big deposits in Canada. People want them.
Yeah, and there's not many new discoveries worldwide. You're seeing a declining balance of that just deteriorate. So, your criteria gets even more strict in terms of where you're looking to make sure whatever you're acquiring does in fact go into production. But let's step back. Let's talk about metals now. So you like copper and silver. You mentioned that recently. Why?
Two different reasons. Silver is despite the differences with gold, both in terms of supply and demand, still trades primarily as a monetary metal. Right. So if gold is going to go up, silver is going to go up as well. Yeah. Silver arguably right now is even less expensive than gold. But as we know, when the market really starts to move, particularly if it's based on inflation, silver tends to outperform gold. Mm-hmm. And with silver, there are far fewer good silver companies, whether producers or explorers. Yeah. There are far fewer good quality silver companies than there are gold companies. So that's silver. Copper is a bit different. Copper is based primarily on, in my mind, the shortage or the shortage of supply. Mm-hmm. Now, when you talk about shortage of supply,
and this has to do with the electrification.
That begs the question of how much increase in demand is going to be. I personally think that the change to electric vehicles and electrification generally is going to be a lot slower than some of the optimists.
Well, you're echoing what Jeff Christian said about that too, is that the consensus estimates he thinks are a little bit too optimistic because there's just too many things in the backlog that have to catch up.
They're based on what we want as opposed to what we can do. Right. In my view.
Yeah.
So notwithstanding the fact that I think the green energy will be slower, notwithstanding the fact that China's demand for copper is probably plateauing after a decade of massive residential and other real estate building.
Right, yeah.
It's plateauing. Notwithstanding any of that, notwithstanding the risk to the global GDP, frankly, from the current tightening. Yeah. The plain fact is that even if you look at base case demand for copper over the next 5 and 10 years, we are not producing enough at today's price. Right. We are not producing enough to fill that gap. So when we talk about a shortage, we don't mean there's actually going to be a shortage. We mean the price is going to go up.
Exactly, yeah.
But the thing about copper mines take a long time to produce. So, Freeport CEO Richard Atkinson says that even if the board of directors gives the approval to what he calls a shovel-ready project today, meaning they've got a feasibility,
everything's permitted, ready to go.
He said we're talking 5 to 7 years before it produces.
Wow.
5 to 7 years before.
That's assuming costs don't change.
That's a shovel-ready project. And so the thing about copper is you can look to next year, the year after, you can look 5 years ahead, and you have pretty good indication of what the supply is going to be.
Wow.
And we simply don't have the supply to meet the demand at today's price.
Wow. Geez, what's your further outlook? Any other final notes? We've talked about a lot here, so.
I'm very cautious on the U.S. economy, and I don't know if you remember, but 2 years ago when we talked, I was less pessimistic than a lot of people on the stock market, on the economy. But I think now we are really heading into a recession in the U.S. that could be very, very serious. You just mentioned savings rates, I think, or credit card debt.
Yeah.
Credit card debt in the U.S. last month had the highest increase in history.
Yes.
Highest increase in history, higher than in 2008. And savings rate has collapsed in the last 2 months, back to 2007 levels, which means that the ordinary everyday consumer in the US, you're not seeing it in consumer spending because the consumer is still spending. But he's spending the same amount of money. With inflation going up nearly 10%, that means he's buying less volume, right?
That's correct.
He's buying fewer things, and he's buying it on credit and taking out of savings. That's unsustainable.
And there's no more stimulus payments that people are getting.
Well,
so
that's
another thing
I
too.
think they're going to start that again, frankly.
Oh, interesting.
Yeah. Well, if we get into a recession, I think they're going to start that again.
No choice.
So I'm negative on the economy, and I do think, along with a lot of other people now, that the stock market is going to, be much lower by the end of the year. Valuations are just far too high.
So positive notes are pretty much just look at copper and silver and be a little cautious, and
gold.
But things are, it's a whole mix. Well, if you want to find out more information from Adrian Day, you can contact him at adriandayassetmanagement.com. We'll include the information below. And you can follow him. He has some news alerts here and there, so you can contact him directly and ask any questions. And that's it. Thank you so much, Adrian.
Thank you so much.
Appreciate it, man.
Glad we're shaking hands again.
Yes, absolutely.